Let me get all the other stuff up and going. All right. So, how's everybody doing? What's going on, Max, Mirza? Hope everyone's having an awesome, bullish day. All right. All right. So, welcome to today's, um, I guess, free trading room curated session where we are talking about intro to credit spreads. Now, there's something that most people don't understand about credit spreads, and it's really all that matters between credit spread and debit spread and things like that. Honestly, all that matters, and I'll show you what I mean when I talk about this, is what your goal is as far as how you're making this trade. And otherwise, it's all the same between credit and debit because they're both longer position and shorter position. All that really matters is your short strike in relation to your ticker price. And I'll show you what I mean. So everyone is familiar with credit spreads. We're selling credit and looking for that credit to decay, and that's how we collect that premium, right? So let's go ahead and give an example here. So I'm trying to think of something that is looking good for an upside move. Like I'm personally in Uber, and we'll set up a. I want to find a setup and talk about a credit spread type of trade. And so there's several different ways to do it. There is the out of the money way, like the tasty trade method, where you sell like 45 days out, and you want implied volatility to be super high, and you sell that credit, looking for the IV, the implied volatility, to decrease. So I'm actually going to pull up tasty trade on my phone real quick. And since they have a scanner that already scans for high implied volatility, so I'm just going to look at that real quick and kind of go over an example of how this matters, how and why it matters, really. And for those of you that have experience with trading credit spreads, debit spreads, and all that kind of things, um, what is y'all's favorite one to trade? And when I say this, also, do you understand exactly what I mean? It says Broadcom's IV is high at the moment, so we'll look real quick. And I guess I'm asking, which do you prefer? All right, so we'll pull this up. All right. So it's because it's going into earnings, but man, that was a solid run. Oh, that's probably because of Nvidia. Whew, it's a good breakout. Okay, so this is not going to work. Let's see. IB rank, IB percentile, it's high. All right, so we'll just use this as an example. So, and this is where where it really matters, where you're really wanting to make entry. But we'll use this just as an example, right? We'll just pretend that you believe price is going to go higher. I'm actually going to scan for a potential squeeze real quick. So I want to find something at an entry that looks like it'd be worth actually messing with. So I'm looking for shorts. Where's my? Here it is. And with today's run, I imagine everything's be kind of already moved, but we'll just use an example with some that I already know. Shop, Dell, Generac, Crisp. Okay, so let's check these out real quick. And then we'll talk about risk, how they work. Okay, here's a decent one. Okay, so is that the 21 EMA? And we're just going to use the setup of a squeeze, right? So, and what I want to show you here is how the structure, all that matters is really the structure of the spread around what you're trading. So is that the daily 21 EMA, potentially about to get a rain fire? And let's just say we think price is going to bounce and hold, right? Because all it really did was come down and test this level right here, almost, and then look for price to continue back up to the upside. So we're going to say our thesis is price is going to go higher in Shopify. All right, so let's talk about this. And its IV is typically high, so this is a pretty good example. All right, so first let's talk about credit spreads. First, what is a credit spread? So a credit spread, whenever we're going long options, we're either buying calls or puts, looking for a price to continue in that duration or in that direction. And The issue with long options, just regular long options that are just calls or puts, like we have theta, right? We have theta. Every day that passes, that position is decreasing in value, right? Implied volatility is also an issue. So if you buy a position when IV is high and say IV decreases, so therefore your position also loses value. So it's more than just you can't just buy calls or puts and let it ride, regardless of what you see on social media. Now, a credit spread, what's really awesome about it is you can get directional while still having theta and IV and the delta direction that you want from just your long option to put in your favor and still get a really good move and increase your probability of profit of it happening, right? So let's talk about first risk. So when it comes to risk in a credit spread, right? So one thing that's really important in every position you take is risk. And I'm really sorry about my really bad handwriting. It's hard to write with a mouse. So risk. So a risk is the width of spread. So if you did 5 wide, 10 wide, it doesn't matter however wide you did it, but say it is width of spread. So I'll just put width of the spread minus, I'll just put CR for credit received. So what would that look like? Let's just say we got in a $5 wide spread and we got 250 of credit. All right, cool. So for one position, all you're going to do is get width of spread minus the credit received. And so that means your risk is $2.50, or for one position, 250 bucks, right? And that's all you need to know for max risk. And if you say you only got $2, right? So that means you're risking 300 to make $2, or risking $3 to make $2, things like that. So that is the risk. Now max profit is always credit received. So I'll just put max pro for max profit is always, I'll just put CR for credit received, whatever that may be. So that is how you determined your risk and your profit. Risk, just to reiterate, width of the spread minus credit received, and max profit is credit received. All right, so now that we got that squared away, let me show you this, and I'm really excited to show you all this, because I don't think most people realize this. And I didn't either until I started doing this, until I started working for a firm and went through all the training that they supply and whatnot when it comes to options. All right, so now we're going to pretend that we believe our thesis is we think Shopify is going to go higher. I want to show you a bunch of different ways you can trade this, and how credit spreads and debit spreads can honestly be the same, but how you can use credit spreads in a way to increase your probability. So our thesis, we think Shopify is going to go higher. So let's build this out a little bit. So I want to go over to Analyze tab, bring up our options chain, and we'll just go 15 days out just for um, the general uh, trade. And then if you're familiar with the Tasty Trade way, they go 45 days out. And that also depends on, that's really good for like gamma exposure, things like that. So they all have their pros and cons. All right, so we'll just use the 15 days to expiration where we're going to get directional, super directional, right? So let me show you how you can structure this. So with the IV high, like their IV is 54%, most tickers are not that high. And if you look at, and this is just Shopify in general, like its implied volatility right now is 53%, but its IV rank is actually low, meaning that per its normal rank, or its normal implied volatility is not really elevated, but it's always elevated, which is good whenever you're looking at directional, anyways. And we're not looking exactly for a IV implied volatility crush. So, like I said, we our thesis is we believe that Shopify is going to go higher. So if we believe that, and we could really structure it any way we want to. So what I'm going to do is, since we believe price is going to go higher, we're going to go over here to the put side, right? So here's the put side. And right here is the delta column. First, we're going to look at this. All right. So for a credit spread, if the closer at a delta 50, that's more of the 50-50 chance you are correct, but also means you're having a good balance of risk reward and probability. If you go further out of the money, say we're to sell potentially like the 56s, right? We get less credit, but probability increases by almost 70%. But if you want to get super directional, you go more in the money, you get more credit. looking for it to play out that way. But that is the quick and down and dirty when you're looking at options chain of building a credit spread. So let's just say we think, right, price is currently at $58.28, and we think in 15 days price is going to be higher. So what you could do, you could go here and we would sell the 58 strike put, and then we can go out and we'll just start off with three wide, and it really all varies. So right here, you're basically risking $2 to make $1, and this is what the risk graph looks like. That does not look right. What is happening here? Okay, it needs to fix itself for a second. And we'll go from a one contract basis. Do not know why it is all the way up here in the 70s, but let's go ahead and crunch that down. There we go. Okay, so if you do not know how to read a risk graph, I personally look at a risk graph every time before entering a trade. I always do. I need to know what I'm looking at, how it's going to look, or how my position is going to react as price moves against me, so I know my entire risk. So that being said, go over here, and I'm going to give you a quick down and dirty. So right here is your profit and loss on the position. Right here is the stock price down here. Right here, this line is our zero line, right? The break even line, basically. And then this blue line is your profit and loss at expiration. So in this case, it'd be June 16th. And then the purple line is your profit and loss for the current day. Now, one other thing I want to point you out to is this little box right here. As I move my mouse around, let's just say today, let's say Shopify jumps up to 60. And we'll just say we'll pause it at 110. So we'll say we got $1.10. If it jumps up to 160, and if you look right here, as I move my mouse over to 60, right? The stock went to 160. You see at expiration, we will make $110, which is the credit received, max profit, because our short strike is out of the money. Or today, because it hasn't fully decayed, we'll make $27, right? So and this is important. I'll show you why here in a moment. And this is just with the thesis of it going higher from here. Now, you could change that, right? I'll go ahead and like, well, what if you wanted to get more bullish? Say you thought things were going to go to 60, right? A pretty good rule of thumb, if you're wanting to pretty good balance of high probability, but a um, pretty neutral risk reward, I guess I would say. You can sell a Delta 60 and buy a Delta 30, right? So right here it is four wide. You're almost getting $2, but it makes your break even point directly behind us. So at this moment, we really just have to place a bet that we think price is going to go at least a little higher. All right. So here's our break even behind us. And let's just say we get 190. So in this particular case, right? And we'll just do this for a quick exercise with the spread, right? What's the width here? That is 4. So simply just get 60 minus 56. With the spread is $4, right? Credit received is 190. So our max profit at this current moment is $1.90, which is $190 per one contract, right? So our risk is simply going to be 4 minus 190. That equals 210. So that's a pretty close a 1-to-1, but the trade-off here is your break even is directly behind us. So things can just go sideways to up for 15 days and you'll be okay. So risking 210 to make a profit of 190. All right, so that's just a good little rule of thumb if you want to balance it out. So I mean, you could also go for that time, but that's a whole other thought process there. So let me show you all this. This is where where it doesn't really quite matter if you think price is going to go, um, basically how you structure your credit spreads, just like your debit spreads. Why it doesn't exactly matter because you're long a short strike and you're long a other strike. All right, so let's just say we have a target of 65. All right, target is 65. So that's about $7. So we'll have to go a little bit further out in time just for this to play out some. So we could just go out to June 30th. Click this off. And so if we have a target of 65, so we sell our target and we go along the 60s. So we'll see how this looks here. And watch this make me a liar here in a moment because the IV is high. Or we go buy the 60 and sell the 65 debit spread. We'll see if it's about the same. Because more often than not, it is. The only time it's not, it depends on volatility. All right, so just to make this even, we'll say we get $1.50 here and $1.50 here, or sorry, 350, 150. And so what we're looking at here is regardless, we have a target of 150, or sorry, target of 65, and we're going to go long the 60, 60, 65 call and or debit spread. So this is the call debit spread. For one position, you're going to risk 150, right? Risk 150, max profit at 350. So check this out. We'll go get rid of the debit spread, put on the credit spread. I'll go ahead and turn this off. Max loss at 150, max profit at 350. It is the exact same. It does not matter which variation you do it whenever you're using that method of whenever you're using a type of target. So that's just something I wanted to point out where it doesn't really matter whenever you just have a target on the chart, right? Now, what matters is even if you're targeting 65, where it does matter is how you structure these short strikes. Now, let's go ahead and flip the script here a little bit. We still have a target of 65, but we don't think this low is going to be taken out at 55. So how can we play this? Like another way you could go about this is we'll go ahead and open the options chain. We'll go a little bit further out. So we still have a target of 65. But let's check out here. Let's see what we got here. Okay, so they're about a delta 30. And then we'll go ahead out and make it, sure, we'll make it 5 wide and adjust from there. Okay, so from here, this is where it matters. And I've actually many moons ago, before I even started working for Simpler Trading, on how I started doing this. I want to go to show y'all something real quick because if you're interested in this, because I think the market is kind of turning back into this type of trading environment where you can do this if you're okay with it. So I want to pull this up for y'all real fast. I'm pulling it up under the monitor. Okay. And it has to do with this. So if you are interested in what I'm about to show you first, it's just like I made this little video long 2 years ago, right? High probability 2-to-1 risk reward trades is using the TTM Squeeze Pro and the credit spreads, right? And if you're unfamiliar with the site, just go to Active Profits on YouTube, and I'm going to show you how I've been doing this, or how I was doing it in the past before the market started to get a little bit more volatile. But if we start to trend higher, I think this is going to be a really good way to potentially trade this method. All right, so let me show y'all here. See, I'll pull up everyone at YouTube real quick. Hey, what's going on, Kevin Stern? How are y'all? Okay, so let's talk about this. We'll have a target of 65, and we believe 55 is going to hold the support, right? Still believe this will be our target. Here is support. So if support is not taken out, right down here at 55, from a one contract basis, we'll get $1.30, right? So we're getting $1.30 a credit. But we believe support is going to hold at 150, or sorry, 55. I don't know where we're getting 150 from, but 50, 55. So you can see from right now, if we were to enter this position, our loss right now would be 57 bucks. But our max profit is 130. So we're risking basically 57 bucks. We'll hold 55 or 60. We're risking 60 bucks to make 130. So that's basically 2 to 1 reward to risk, right? We're risking 60 to make 120. It's a little better, right? And then so even as price moves up to 160 up here, right? We could get out at our target for a profit. And even as price goes sideways, we still benefit, right? So if our target's up here, regardless of how long till expiration this is still working in our favor. We have the delta direction we want to go. As long as it doesn't crash down, we're still good. And what's the beauty about it is say as the more time that passes, this P&L gets higher and higher, and say it just oscillates here, you don't really hit our target for a long time, and then eventually, we'll say 3 weeks from now, it comes down to 55. Guess what? We still may get out for break even because all the theta that decayed out of this position as time was progressing. So this is just one way how I used to do uh, risk one for two reward in a high probability fashion based off of this type of setup. I hope that makes a lot of sense there. I know whenever you see this, you're gonna think, "Oh my gosh!" Like I want to, if I was to right click and want to confirm and send, it's, "Oh my God, I'm risking 370 for 130." Yes, but you have a level where you want to stop out, and then we are further out in time, just enough to where, if it was to fall against us, our gamma exposure isn't overly done. So that's one how you could use credit spreads and variations, and you could also get super directional with them. Like I mentioned, if you were just wanting to high risk reward, notice, like I mentioned, these were about the same. Like it really didn't matter. What matters is where is the sold strike and how far in duration do you have for that position. Um, so I'll follow up with that. Any questions, and does that make sense? I want to make sure everyone understands. This is one cool little way you can tweak credit spreads to work in your favor. So if you have any questions, I'll go ahead and give you a moment to throw it on. Like I do really like the setup. I may actually just throw it on for myself. All right. Let's see. I see nothing popping up on YouTube or Facebook. I'm gonna go ahead and check out the option, or sorry, the free room. Max, can I repeat again about the short sold strike? Okay, so all that matters whenever you're doing a credit spread, all that matters in terms of risk reward at your target, all that matters is where is the sold strike pertaining to the ticker you're looking at. So like right here, we're sold to 55s in that example, right? All the way down here. We sold to 55s and then looking for price to go higher, right? So I'm gonna go ahead and get rid of that and then click here. So that is what it matters there. But if it where it doesn't matter, so say we did it more at the money, right? That is whenever it gets pretty much the same whenever you're doing it in this fashion, right? 65, 60, 65, 60. It's the exact same. Here's a put credit spread and call credit spread. And they're exact same. They're both max profit at 65, right? Both risking 150, you make 350. If you did a debit spread, um, still 150, 350. All that matters is the sold strike. With credit spreads is always based where on price to go. No, that is a trading strategy itself. That's not particularly with the credit spread. That's more of how you're structuring the trade. But the credit spread really depends, right? So if you think about it in this way, so let's use this as an example. If we're to use the June 30th, like right now, this is a very aggressive trade. Like you are thinking price is going to skyrocket up to 65 within this time frame. And it may and it might, right? So this is a very aggressive directional trade. Now, if you wanted to take the conservative high probability approach, here is another way where you're still targeting 65, but you have a little bit more money on the line, but you're putting all the other Greeks in your favor. That is more trading plan based versus credit spreads, period, if that makes any sense there. No, you don't need a minimum delta 25. That really all it depends on how what your trading strategy is that you're doing, TJ. Or really, or like you could do it more at the money. Say you're like, you know what, I think price is going to go up no matter what from here. So if we're at the 58s, you could do at the money. Like a really good high probability trade is you can go 30 days out. Let's see, June. We'll just go to June 30th. Go at the money. So if we did the 58s, which is say 3 wide, we'll see what this looks like. So not too much there. You might have to go to the 59s, 56s maybe. Then you could play with it if you wanted to make it more one to one. Like that's all you could play with it. So right here for one position, if you did at the money, 165, 135, that's pretty close. If you wanted, you could bring this in a little bit more. Yeah, so right there, it's too wide. So now that's almost one to one, a little bit closer. But hopefully that makes sense there. See, so is it more about how you want to go after your target price? Yeah, pretty much. It really depends on what your target is and how you're looking for it to go there. Is that the money more expensive? Yes, it will define more expensive. Like you in a credit spread, you would want credit spreads to be more expensive because that means the more you're getting paid. So, but if you go deeper in the money, right? If we were to use this case, let's go ahead and do. Let me show you this example. So, if we were to go back with this one, right? So that's where we sold the 65s way in the money. You can adjust this to where this was. See, we sold the 65s, and if you want 55, what does that look like? So now it adjusts it to where you're still getting paid more. Your break even slightly ahead of you, but it's still a close one to one. Yeah, you just play with the strikes, really. But the deeper in the money, the more premium you get. But depending on the long option you buy, you hedge it out with, is going to determine how much more out of that position you get relative to stock price. And those of you over there and on YouTube, can one of y'all give me a thumbs up or just type a one or something? I just got a reading that I potentially may have had a disconnection over there. I just want to make sure I still have y'all over there. Okay, see if they pop up. All right. So, do I line soul strike support and resist level? I personally do max yes. Depending on what I'm trying to do, it depends on the trade, on the trading plan and trade setup. Um, that's really what matters here and how aggressive you want to be. But personally, like one way I was taught to trade was like your sold strike is always your target, and that's just one way to do it. That's if you're going to get super directional. Like the other way, like if we talked about this out of the money longer duration version, oh, not that version, it was this one, right? This one, then that's not so much the case there because it still has your target's up here at 65, but we're still giving it a buffer room to get there. But if you're getting directional, yes, you can sell your target. Awesome, it's working. Thank y'all very much, Captain Jane. Thank you. Thank you, Richard. All right, cool. Any last minute questions? I really hope that made sense. But for a quick recap, all that really matters is remember your sold strike relative to the stock price. And then from there, your risk. Whoa, that was not a very good R. I apologize. I'm sorry your eyes had to see that. Your risk is the width of the spread minus credit received. And then from there, your max profit, so I'll just put max pro, is your credit received. So that is how they are structured out and that's how they work. Nothing else. Everyone good? Cover losing? What do you mean? Can I cover losing? If it's losing, if it's going against you, close it. If it's going against you, I would define cover closing it. So if you go to your broker, you just click close or whatever it has. It depends what you're trading on. Their team increase 2021, but that's the variable there. That that's where it's so if you're asking me 50%, 20%, that is trading plan dependent. No, you could still hold it into your soul strike. And actually here, I'll cover this real quick. This is something also no one really knows about. I'll go over a few minutes. Hey Mirza, if you are listening, or if there's another moderator coming up after me, let me know. But I want to explain this one thing about this is verticals in general. It doesn't matter if it's credit spreads, debit spreads. I just want to show you all with this because Mikey says you have to close it before it hits your sold strike, and I'm gonna tell you no, you don't. I'm gonna explain why. All right, so let's use Shopify as an example. All right, because when I hear this, I'm like, oh, that is not true. Okay, and I'll explain to you what your broker does for you. So we're going to use the example of this right here, the 60-65 call debit spread, right? And it doesn't matter if it's credit spread, debit spread, it's all the same. It's a vertical. It's going to be the same thing. No, it could go through it. It could go to 100 and it doesn't matter. And I'm going to explain why. All right, so you're long to 60 calls and you're short, and I'll just put minus 65 calls, right? And right here, we'll just say you got in for $1.50. News comes out, Shopify spikes up to, just for fun, we'll say $150. It doubled. All right. Now you're thinking, oh my gosh, I want to be put shares. No, you are not. Let me explain to you why. What is going to happen is you're just going to hold your position into expiration. And then you're thinking, Kody, that's crazy. Why would I want to hold it into expiration? I'm going to explain to you why. The second you change anything, you're going to completely change the structure of the setup that you got into. So if you're just going to hold it into expiration, you were at max profit. If this thing falls all the way back down, then Shopify is having some problems. So what's going to happen? Expiration June 30th rolls by. We're closing at $150. Your broker is going to go in. You're going to get assigned shares at $60 a share. Great. The stock is up at 150. You got assigned shares, but your short strike's now in the money. And then, so what they're going to do is these shares that you were just assigned for $60, your broker is going to go and close them at $65. So you basically just open shares at 60 and close them at 65. And then you'd be like, okay, but you're not going to make $5 profit because, so you got that $5 wide spread, right? It cost you 100 or $1.50 to place this trade. So then you're going to get your $5 minus your 150 to place the trade. So therefore, your profit is still going to be $3.50. So that's what's going to happen if it goes all the way through your short strike. You're going to be assigned at 60 and closed at 65, and you won't even know what happened. But that's what the broker does. Like you could hold them into expiration. Like the firm I trade for, they prefer you to position size from max loss, put on your trade, and just hold it into expiration. If you're right, you're right. If you're wrong, you're wrong. Position management was what held it there. And if it goes into max loss, same thing. You could just let it go to max loss. Same thing. So not very many people know about that, but that is a very real thing and done it a million times. Same thing if it goes against you. If it is outside any of your strikes, you can just let it go for max loss if you wish to not close it. Orlando, is there videos of simple training explaining this option strategy? Maybe. I'm pretty sure we have some like in the training room. I'll Slack Mirza to see if he hook you up because I'm pretty sure we do. Or one of the other ones. Someone may know, have the link for you, but I'm pretty sure we do. But that is my time, everyone. I hope you found that beneficial. Like I said, once at max loss, no use to do anything until expiration. Sure, yeah, okay. Now it's any spread, any vertical. It could be iron condors, butterfly. Well, as far as expiring, there is a little bit more finessing with condors and butterflies, but that's for a whole other topic. But that is the ins and outs of credit spreads. Just play with them, and that's how they work. But yeah, if you have any questions or anything like that, you can find me in the options room or in the small account mastery as well, and we'll get you squared away in anything, all things trading. But everyone have a great day. Hope you're having a good start to, well, I guess midweek. It is what, Thursday? End of the week now. Went by fast. But everyone have a good one, and I'll catch y'all later. Take care.